Okay, I think we shall get started with those who are online. So, hey everyone, welcome to this Kristal webinar in partnership with Quantyr. My name is Ashwin Patravali, and I'm with the Sales and Business Development team at Kristal, and I'll be moderating today's webinar. So, those of you who haven't heard of Kristal, I'll just give a quick introduction of who we are. So, Kristal is an AI-based asset management platform that looks to lower costs and bring transparency and improve alignment of the stakeholder interest in the current wealth management industry. What we essentially do is we crowdsource aspiring portfolio managers and traders from across the globe onto our platform and use their trading strategies to create their portfolios or crystals. We also do have an in-house developed machine learning algorithm which we use to identify optimal portfolios for the end client. And using technology, we seamlessly replicate this directly into the investor's account. We're currently licensed in Hong Kong, Singapore, and India. Kristal.AI is app-based and web-based, so you can download us through the App Store on iOS or Android, or check us out on https://kristal.ai. Incidentally, I will run a short demo at the end of the Q&A session, so some of you can see what our platform looks like. Okay, now that we got that out of the way, moving on to the fun stuff. So in this webinar, we'll be covering some of the key themes from both a macro and thematic perspective that are likely to impact the investment landscape in 2018. We're fortunate to have with us on the panel two very senior investment professionals in the industry, Vivek Mohandra, who's with Kristal.AI, and Laurent Lequeux from Quantyr. And they will be sharing some of their thoughts and insights on the trends for this year for investments. Okay, so I think we're all good to get started. I'm going to hand over the stage to Vivek, who'll kick off his presentation and share some of his insights on the investment landscape for this year. Over to you, Vivek.
Thanks, Ashwin. Yeah, it's been a very interesting year, a very interesting start to the year, I would say. Last year was a relatively easy one, so I'll start with that. Nothing is going to be as easy in 2017 as it was last year. So we started off with a bang. In 2017, you could have pretty much done anything and it would have been right. If you had bought stocks, the more risky, the better. You could have bought technology, emerging market, China property. It went from being expensive to even more expensive. You could have bought cryptocurrencies. The less you knew, the better it was, the better you would have done. The smaller cryptocurrencies did much better than the big ones. And the volatility carried trade. That's a bit of a complicated structure, but that was a big one for the whole of 2017, almost 170% returns on that one. And that basically meant that there was very little volatility the whole year. So it was an interesting year in 2017, lots of money to be made. Average returns were 30% plus. 2018 has started off with a bang, and February was the main year which caused all the volatility. The carry trade, which had been so successful the whole of last year, basically lost $3.2 billion in almost 90% of $3 billion in a matter of 3 to 4 days, and basically got knocked out, stop out. So it gives us a good chance to reassess the markets for this year. The dog needs to be very, very hardworking, I must say, in order to get any kind of returns similar to last year. I don't think people are aiming actually to get similar returns, but it's more about preservation of capital, more about making sure you pick the right stocks, the right markets, etc. So what I'm going to do is look at some of the trends which still remain after this volatility in February, and some of the trends which have kind of broken down. So looking at the US dollar interest rates, ultimately this has kind of been a big determinant. The original volatility was brought in because of the increase in interest rates, and the interest rates have been kind of going up, but the move started much longer. If you look at the 2-year treasury, the 2-year treasury has been kind of going up from almost middle of 2016. So it's not something which is new, but all the volatility kind of just happened at this point of time when suddenly people realized that, oh, what's happening? And interestingly enough, if you see the difference between the 6-month LIBOR and the 2-year Treasury, this has kind of narrowed out over the last 2 years. So that's a very interesting phenomenon, and that has some things about to do with the Hong Kong dollar market also, because the Hong Kong dollar market follows US interest rates. So we'll see an increase in interest rates here. But also interestingly, the 10-year Treasury has kind of like jumped up over the last 4 to 5 months, and that trend is even more dangerous. So these are some things to keep in mind for the rest of the year. So this increase in interest rates is a trend which is not going to change. That's our view here. Looking at exchange rates, again, a very interesting phenomenon. Nothing has happened in terms of the last 2 months where the stocks have seen a lot of volatility, but foreign exchange rates have been on a one-way trend. After the US presidential elections in November, the dollar has been steadily weakening the whole year. And that's going to be another thing which is going to remain. The volatility hasn't really affected that. The stocks have been affected in a different way. So that has some learnings for us. So a strong momentum in yields, and this can accelerate quite a lot. President Trump has already created a big difference between demand and supply for treasuries, and that can really blow things up in terms of 10-year and the 30-year. Right now, it's a relatively flat yield curve. So between 30, 10-year and 2-year, it's very, very flat, and that's a very crowded trade. I would call that a very crowded trade. That's similar to something else which can blow up once the pricing goes through certain critical points. And the uptick in inflation is not really priced in. Real yields are very, very low. So if I go back to the previous slide, at 2.2% in the 2-year Treasury and almost 2% inflation, the real interest rates are hardly anything in the US. So that's something which can kind of really blow up. So we can, and if it blows certain critical chart levels, that's a 3% on the 10-year, it can go very quickly to 3.5%, 4.5%. So that's something to watch out on. On the currency side, US dollar and consequently Hong Kong dollar will continue to look weak against all the other currencies. The strong macro trends, the global growth rates, PMI are in sync, very, very strong data coming out from China, Europe, India. So those will kind of continue to push pressure on the US dollar. There may be monetary tightening, which we'll see out of EU and the Bank of Japan, and that could surprise to the upside. And the CNY has been appreciating. That's a pretty good trade to be in. The CNY seems to be has appreciated in the last 6-8 months. I don't have a graph here, but to be going long CNY is pretty safe bet, and take advantage of higher interest rates in China also. We have a way of doing that, and that's something we would recommend. Stocks. Now, this is where the interesting part is. Stocks have really kind of changed a lot over the last 2 months, and that's where it's been really affected. So this is a chart. I need to get rid of the things. So if you look at the P ratios, the P ratios have basically been on a one-way trend from 2011. So this chart is about P ratios in the Hang Seng, the Nifty, and the S&P. And if you look at the P ratios, they've been kind of going one way. Since 2011, and are kind of our historical highs. You have to exclude this part because this was after the crisis. So leaving aside that, we are kind of at new highs in terms of P ratios. And the Hang Seng P ratio is relatively small, but remember, that's because a lot of financials are there. If you look at Tencent and some of the technology stocks, those are at very, very highly elevated levels. So P ratios have been up, and that doesn't leave much room for them to grow up further. In terms of the breakdown which happened in February, if you look at Hang Seng and the Nasdaq, which is this graph, this has broken the trend line, and now we are talking about a breakout here, and it's unlikely that it will again head back up from here. However, if you look at FANG stocks by themselves, so just technology hasn't really broken out, and the trend remains pretty strong, which is quite unusual. So The technology stocks people still seem to have faith in and belief in, but it's the rest of the stock market which is kind of lost the ground, and that's have some, again, learning for us. Commodities, looking very bullish because it's at, the low was touched somewhere in 2016 here, and after that, even now when we are at this level, we are not very far away from the lows. If I go back to 2008, 2009, 2010, it was significantly higher at this the commodity prices level. So this is excluding agriculture and some of the softs. So this is basically metal and energy, and that looks set to have a kind of a bullish trend. So what are our learnings from the slides which we've seen in the recent in the last few 4-5 slides that we've seen? 10-year, 20-year treasuries and US interest rate can jump quite significantly, and that means to be going long the fixed income markets or for longer tenor may not really make sense. You may lose a lot on terms of duration. So you have to kind of go at the shorter term bonds. So for safety, we are recommending 1, 2 to 3 year bonds, and at that even for that maturity, you're getting reasonably high interest rates. For example, you'll get like 2-3% in US dollars, the higher if you take some risk. Commodities are looking pretty stable. So commodities, high yield bonds is something where you can go for additional spread. You can also do some yield enhancement through sale of some call options on the market, etc. So short-term safety in bonds is something which we would recommend, and also sticking close to commodity sector is something we would recommend. We also have on our platform a lot of protection strategies. There's inverse momentum crystal, FOMO with risk parity. I won't go into the details of these, but you may like to go onto our platform and check out what these contain. But these are basically bearish trades, and they protect you in case the markets have a downturn. Longer term, of course, I think the global growth market is looking pretty strong. EM will continue to outperform, and with US depreciation, I think from 2019 onwards, you will still see outperformance in China, India. The consumer story is well in place, and that will be a good bet to take a longer tenor. With that, I kind of come to the end of my presentation. But one thing I want to end up cryptocurrencies, because that seems to have taken a lot of our mind the whole year. 59% of the ICOs kind of tracked by token data seem to have failed in the last 1 year, but 41% are still around. And people have done pretty well in cryptocurrencies. Despite all the stock volatility, the market cap of cryptocurrencies hasn't really gone down that much. It's still at about 450 billion compared to about 550 billion at the 2017 year end. It did peak out above 700 billion, but it's still there at 437 billion even as of today. And cryptocurrencies can give you a free lunch. How does that happen? Well, I counted the number of blockchain and cryptocurrency events in Hong Kong last month. More than 50 events. So you can do 2 a day, and you can get free lunches and snacks and free drinks. With that, thanks for listening to me.
Thanks, Vivek. Actually, we've just got a quick question, so I want to post this through before I move on to Laurent. So we've got a question for you, Vivek, from one of the attendees. So the question is, the gap between the 2-year treasury bond and LIBOR has been decreasing. So could you repeat what this, or clarify what this means?
Well, basically, the 2-year treasury was higher. Let me see if I can get back to that particular. Let me just see if I can get back to that particular slide. Yeah, basically the yield curve kind of has been flattening the whole of year. I'm finding it difficult to get down there. Let me just try for once more time. Yeah, effectively the yield curve has been kind of flattening the whole of the last 6 to 12 months. Let me, sorry, 1 minute. I'm just pulling it up myself for that benefit. So 6-month LIBOR was always higher, basically because that was predicting that in the short term, Fed will continue to tighten policy, monetary policy, but longer term, they will not really be able to control longer term interest rates, and longer term interest rates will continue to remain lower. So that was basically no inflation expectation in the future, also not significantly higher growth. So the short end was kind of affected by Fed, but the longer term, the market was saying nothing going to happen. But now the market is definitely saying that there's going to be a bunch of hikes in the next 2 years. So there's going to be 3 or 4 this year. There's going to be another maybe 2, 3 next year. So for even the 2-year time horizon is definitely for interest rates is much higher. But right now, the market for the 10-year and longer tenor, people are still saying no, interest rates are not going up a lot longer tenor. And I think that's where the risk is. With the kind of fiscal deficit in the US, the demand and supply of treasuries, monetary tightening coming up, something happening in Europe in terms of tightening, the 10-year treasury can jump up quite a bit, and that can create pain in many markets, including the Hong Kong housing market, the US housing market, and obviously stocks, because as interest rates rise, the stock P ratio should kind of come off a little bit. So,
right.
Yeah.
Okay. Yeah, thanks, Vivek. I hope that answers the question. So look, Vivek, thank you for your time. That was very insightful. Look, 2018 indeed looks like the year of a hardworking dog. So we'll see how it plays out. I'm going to now move over to Laurent, who's going to run through his thematic presentation for you guys. Over to you, Laurent.
Yeah, thanks, Ashwin. So I will go through the presentation. Sorry. So this presentation will take a look at where to invest in 2018. And first I will introduce a bit of Quantyr and who we are. So I've been in the financial industry for almost 20 years in Europe and in Singapore. I've developed some quantitative screening historically, continue to work on this matter, and I've been in the private banking and financial industry so far. So what's Quantyr Smart Growth? At Quantyr, we focus on quantitative screening. We look at free cash flow rather than EPS or sales growth, because we think that free cash flow is a key element for stock performance. Now we'll have a look at the 5 investment themes that we think that we have to focus on during this year. As Vivek say, this year we think this will be more thematic and more stock picking than ever. First theme that we like and still like is China. We think that Chinese equities have further to grow. Still have more development in the new quality growth that the government wants to impose. And the market is still relatively cheap compared to other developed and emerging markets. Europe is a bit a contrarian recommendation that we have here. We think that the market is unloved by investor, and the market has already underperformed US and should recover in the coming months. In terms of sectors, we like 3 sectors in particular. We like financials. We are in a higher interest rate environment, so we think that rising yield is a good environment for banks and other financial companies. And they can improve also. We have a strong economic growth, means that loan growth will remain sustained. So it means that free cash flow should be very strong for the sector this year. Mining, as Vivek say, we have a very constructive view on commodities and on mining and energy especially. So we think that the very good economic growth environment we have, limited supply, and also more discipline in the sector is a key source for further free cash flow generation. And last but not least, energy. We think that the market underestimates potential of growth in this sector. We have, I would say, relatively positive view on oil price, but it's not really what does more matter. It's more a stronger balance sheet and also improvement in EPS growth that should drive the sector this year. So that's all I have, and thank you. I will take some questions later.
Thanks, Laurent. Thanks for that. Those are some indeed interesting trends for this year that we need to look out for. So now that we've concluded the two presentations from our panelists, we're going to open this up for the Q&A session. Now, before we started the webinar, we did ask some of you to provide your questions that we can present to the panelists. So I'm going to go through some of the questions that we received. But please, if you have any questions now, do you post on the Q&A button, and we will try to pick it up during the course of the webinar. So just to go through some of the questions that we've received, and Laurent and Vivek, you can choose to pick this up or whoever feels most comfortable. So the first question that I'll address is, which markets for you, in your opinion, represents the most risks and opportunities in 2018? Laurent or Vivek?
Opportunity, I would say financial and commodities are the two markets where I see the major opportunities for this year. Especially commodities, I think a lot of investors are not yet back in this thematic, and are still quite worried of, the previous cycle, a lot of investors lost a lot of money. So I think this is a good opportunity in commodities. Financial, as I said, is a sector that I like and we like because higher interest rate is very good for banks. Risk, I think that is more, I would say that this year we could see really underperformance of the US market in general, the US equity market in general. And I'm a bit more cautious on the technology. I think it's a crowded trade, and there are very few, I would say, positive enhancement that can come for this sector yet, that they are not pricing in this sector.
Right. Now, for those three sectors, financials, energy, and mining, is your view just for this year, or do you think this will be an extended time horizon, maybe going into next year as well?
Well, I think for financial, it's especially this year that you will have the pickup in the earnings. I'm more worried for 2019 for financials, because if the Fed really goes through what they have said and continue to raise interest rate, at some point in time, rising interest rate too much is not good for the sector, because you slow down the economy, and 2019 looks much more challenging on my view than 2018 on that side. Commodities, I think we are back in a slow recovery, but what I like in commodities is the miners, especially the oil companies, have learned the lesson of the previous cycle, so they have been very, very cautious in terms of investment, and this will impact the supply. And the demand is still very good because you have, I would say, China, India, a big source of additional demand in the coming years.
Yeah,
okay.
Just to add, I think I kind of agree on commodities. 2018-19 is going to be a very tough year. We are probably heading into a recessionary kind of environment in the US, with inflation picking up, higher interest rates. So you have to be very careful. I think preservation of capital is going to be very important. And it's not going to be like maximizing your return, but making sure that, you kind of keep your capital. So commodities, definitely we are coming into an upcycle for commodities. It's started. There's very little downside on commodities. And as Laurent pointed out, the balance sheets are relatively strong. But they can't really have too much growth because there aren't that many assets available for them to buy and grow. So it will be a very stable kind of thing. And also on oil, Saudi Arabia seems to have kind of got their act together. So oil definitely seems to be range bound and not going to go down to $30, $35 like it was a couple of years ago. So, energy and metals looking pretty good there. Technology, for some reason, is still protected. The rest of the market had volatility, but technologies kind of stayed up there. And I think that's just, if you have some risk-taking ability, you can kind of go there in that sector, even though the pricing is really expensive. But I think people are getting ready for a new world.
Vivek, when I use my quant screening, I see less and less technology stocks coming out of this screening. So I'm quite a bit worried, because the numbers are not matching what the people say.
Yeah, that you know, 10 cent at 100 multiple, and you know, but that's where the future is, right?
Yeah, I agree. But I've been there for at the previous TMT bubble. So uh, sometimes I mean, it reminds me that people see the bright spot but don't look at valuation. So you have to balance everything.
Right.
That's
So I think it'll be a good. Thank you for sharing that, both of you. What I want to actually do right now is do a poll and ask the same question back to our audience. So for the audience that's online, I've just launched a poll, which essentially is asking you, what do you think will be the thematic trend that will outperform for 2018? Um, uh, do put in your votes. I think it'll be interesting to see what everyone else thinks, and I'll share the results shortly once everyone's got their answers in. Okay. In the meanwhile, I'll just go to another question that we received. Maybe Vivek, this is for you, given your fixed income background. But what's your view on the investments in high yield bonds, and you know, your view on the forecast for Euro USD going into this year?
I think high yield bonds still offer value because you know, I'm not talking about very long term ones. So we're not going 5 year, because then you are also running some duration risk. So you know, but at the short end, you know, 1, 2, 3 years, you know, I think the interest rates are pretty looking attractive. We are not really going to see a high increase in default rates, etc., happening. So I think, you know, those bonds, high yield bonds, especially commodity sector, offer value. US dollar is going to be relatively weak, so I would tend to prefer other bonds. I mean, Chinese bonds, for example, CNY bonds are attractive, and I hold them in my own portfolio. Euro, the bonds are still very cheap, very expensive, because of the European Central Bank continuing to buy them. So the spreads are much lower than they should be, just because of ECB is the biggest buyer of these bonds. So I'd kind of wait a little bit before buying bonds in euro. But CNY, dollar, high yield, I'm still bullish, and at least you'll protect your capital and get your 3-4% return there.
Okay, thank you. And and given China seems to be the hot topic, what's your view in terms of how best to buy in China, and specifically where the opportunities?
Well, I'll let Laurent.
Laurent, you want to pick that up?
yeah. I think my view on China is that still have a lot of opportunities, and especially in new sectors. I think here in healthcare, leisure. Again, if you look at the Quantyr Chinese equity portfolio, is away of the traditional name that the retail owns, like the Tencent and so on, and is more targeting this kind of new sector like healthcare, leisure, and so on. And I think that's the next key of growth for China will come from these new sectors. That's what the government also is targeting in China, is that wants to promote local consumption and go away to the traditional, I would say, growth model based on exports.
Okay. Perfect. I think maybe just one more questions from the RSVP list that we've got. So I think maybe this is for Vivek, given that we're a fintech company. So Vivek, what's your view in terms of the investments that are going to be made in the fintech space going forward, and what do you think the future is?
Well, you know, the Hong Kong government just announced like a 50 billion grant for, you know, technology and smart city, and that includes fintech, etc. So there's a lot of money being poured in by the governments in this area, and fintech is still ripe. I mean, there's a lot of way to go before it gets the disruption models truly takes off, like it has happened for e-commerce, retail, payments, exchange. So I think fintech still has many more bullish years left ahead of it. We will announce, you know, fundraising soon, which has been kind of completed now. So once we go public with that, that's been quite a positive thing. But that's reflective of the whole sector where money has been, you know, money is still continuing to be poured in. I was looking at the numbers for similar companies in the US, robo-advisors, and people with a similar business model as us, like Wealthfront and Betterment, and they continue to grow very, very rapidly. So I think fintech has quite a few more years to go with the same pace.
Okay, thank you. So I'm just going to share the poll results as well. It's interesting. So we've had some submissions come in. It looks like in terms of thematic trends that people think will outperform in 2018, it's Chinese equities and energy, which seem to be well ahead of the rest. So that's an interesting feedback that we've got, and in some ways very similar to what Vivek and Laurent have shared as well in the presentation.
Yeah, well, we wouldn't vote, but if I'd voted, I would have probably voted the same.
Right. Okay.
Well, for myself, I would have voted for financial. And I think the sector is still well unloved. I can see that our participants already doesn't love this sector, financial. I think there's a lot of potential good news coming for this sector. And it's not only in the US, but in China also.
I think the sector will still have some disruption from people like us and some other fintech companies. And there are a lot of cockroaches in that sector, like Wells Fargo. Wells Fargo cockroaches are still not coming out, because if you look at Warren Buffett and what he said, there are still some issues with the financials which have not kind of.
I agree with you, Vivek, but don't forget the largest fintech company in China is Ping An Insurance.
Right, true.
Okay, well, we've got another question from the audience, and again, this is on the same fintech theme. So obviously, because Kristal is very much using AI and ML, Vivek, what's your view in terms of the role that artificial intelligence and machine learning is going to play in investment trends going forward?
Well, I mean, it's not just in fintech, but it's going to be in many different industries that it's getting involved in. But I recently saw a study. I don't know whether, I think it was Microsoft. Microsoft did a study on where's the maximum money to be made in AI. And surprisingly enough, I think top two, I think it was number one or number two was trading. AI used for trading. We don't actually use AI for trading. We use it more for advisory, but that's what came out of the Microsoft study. And that's where, in terms of revenue numbers, where the benefit will be, i.e. the number of people using AI for trading and benefiting from that. But
I think Vivek, some connection issue. So I'm just going to move on to some other questions I want to ask both of you. So Laurent, you're still there, right?
Yes.
Okay. So Laurent, in your presentation, you talked a lot about quantitative screening, as well as the importance of free cash flow. So could you elaborate a bit more in terms of why do you focus on quantitative screening, and why free cash flow over, say, EPS or sales numbers?
Okay, so first, quantitative screening, I think, is also part of the fintech revolution, is that most of investors, they invest based on their fears or on their greed. They follow the flow of investment, but they don't really look at numbers. And then at the end of the day, numbers have no feelings. That's one point. So it's a very no greed, no fear screening. And also what I like in quantitative screening is very scalable. We are a very small company, but we are able to develop various portfolios, because it's, at the end of the day, it's just a machine screening. So once you develop your screening, you can turn it on Europe equities, Chinese equities, or various sectors. So scalability, and also, I would say, focusing on what is important, the data, is key. So why we focus more on the free cash flow rather than on the EPS and on the sales. We think that the free cash flow is really what matters for investor, because at the end of the day, it's what the company has to invest or to give back to you shareholders, and that's what's left in their pocket once they have paid their debt and so on. So I've been a big believer in this positive free cash flow investment. And when I moved to Asia, in fact, I found that people here in Asia take for granted that financing is easy. They can get easily free, let's say, money from the market. And so they don't really look at the free cash flow as a key data for growth. But I think that at the end of the day, if the company wants to grow on its own and without being reliant to the market, free cash flow is the key data.
Okay, well, that's a good point. Thank you. I just want to pose another poll out to the audience now. Obviously, this is probably a little bit more specific to Hong Kong. As most of you in Hong Kong are aware, property is obviously a hot topic for investment, and people are always speculating around that space. So I'm going to put up a poll right now, asking you all what you think is your view on the Hong Kong property prices in the next 2 years. So look, even if you're not from Hong Kong, feel free to click away and give us your views. So the poll is now live, so please go ahead. We have one more question, and I guess this is something for Vivek, because he was talking about Tencent earlier. Now, Tencent obviously has got a lot of hype, and it's pretty much become a household name where everyone talks about investing in Tencent. Vivek, in fact, jokingly said that the Hang Seng should be called Tencent. So with that,
it already is.
Yeah, so Vivek, I mean, what's your view on the current prices for Tencent? And do you see this? Where do you see it ending the year, essentially?
Yeah, well, it's an interesting company because not only does it have technology, but it also has barriers to entry. So it has a kind of monopolistic position because in China it's protected from competition. So it's got both components of technology as well as protection from competition. But of course, there's some political risk because I think earlier they were mentioning that the government may want to take some percentage share in it. But over and beyond that, yes, the valuation is crazy, and Laurent will point out that the free cash flows may not justify this company, and it's kind of falling off the screen.
But I would say on a strategic basis, I would prefer Tencent to Amazon.
Okay, yeah. Well, definitely there's less competition in.
They have the government with them. Amazon, at some point in time, the US government may be against them.
Oh, well, I think, yeah, that's true also. But I think, yeah, like I said, even despite the volatility, the technology stocks have kind of been relatively well protected, and they haven't really come off, and they haven't broken the trend lines. And the future is definitely there in terms of technology. So it's a relatively safe space to be in. Whether it goes up by end of 2018 or not, I'm not sure. Probably, it will be in the plus 5% range. So it won't give you the kind of returns it's given over the last 2-3 years. But it should be a safe place to hang out in.
Okay. And what's your view on the Hong Kong property prices? Because I've just got the poll results, and it seems that people are mixed between it being flat to up 10% to it being down less than 15. So no clear winner there. But what's your view?
I think with interest rates heading up over the next 2 years, that's going to be one of a dangerous place to be in. With highly leveraged, and with Hong Kong Hong Kong interest rates falling the US interest rates very closely, that is a dangerous place. Yeah.
Okay. Well, I think there are no further questions from the audience, and we've gone through a fair number of questions already. So one of the few questions we did receive also from the RSVPs was a bit on our platform. So what I'm going to do is use this opportunity to just do a quick demo of our platform and share also our advisory engine that we have that uses machine learning. So just bear with me while I launch that. Okay, can you see my screen, Vivek, Laura?
Yes.
Okay.
Yeah, clear.
So this essentially is our portal. You can access this through Kristal.AI through the browser. So what you see over here essentially is a dashboard where as a client, you will get to see your NAV on a daily basis, what your investments are across various crystals, including the performance. What I want to kind of go into a bit more is showcase our advisory engine. So if you're an investor who's unsure about where to put your money to work, given the market, we have an engine which is currently in the beta phase, but we most of our clients do use it because it does marry up very much with the advice or view that we have. So what you see in front of your screen is one of the few questions that we ask. So the first question we typically ask our client is, what is your investment goal? Because investing always should be tagged to certain goals. So for example, say that I want a growth-based portfolio. The next question obviously it asks is what size of portfolio are you looking to invest? Because this is important because every portfolio on our platform has a certain ticket price. So let's say I've got $100,000 to play with, and I want to invest in a growth portfolio. I don't really care which region, so I click any. And then what it does is based on the KYC and risk profile questions that I have answered during the onboarding process, it does a matching and recommends a portfolio for that 100,000 amongst the list of crystals that we have on our platform. So we currently have over 100 crystals or portfolios. And in this case, it's recommended around, say, what's this, 7 portfolios. So it's allocated these 7 portfolios of the 100,000 across these 7 portfolios. You get complete visibility into the platform returns for each of these. So for example, say, I want to look at Quantyr Smart Growth US, right? So this is one of Laurent's portfolios. You can click on that and get complete visibility into what the strategy is, what the entry price is for this as of today, historical returns. So since this portfolio has been on the platform, roughly 18%, as well as transparency on the fee structure, fixed and performance. The client can even drill down further to see like what the portfolio breakdown is, to see what growth stocks is this portfolio investing in, as well as back-tested returns going back up to 5 years. And basic analysis that you can see in terms of industry split, as well as across geography and currencies. So this is just a quick preview of what our platform offers. Of course, like I mentioned, we have 100 plus crystals on our portfolio. Of course, clients can choose to view these and search for these through the browse feature and filter, or use our recommendation engine to get that advice. So I think from our perspective, I will just take a pause over here to see if there are any further questions. Do feel free to check out our platform. Again, as mentioned, we're app-based, so you can download us at Kristal.AI from the Apple iOS App Store, as well as the Play Store on Android, or just visit us on our website. Once again, thank you everyone for taking our time from your busy schedules to attend this webinar. We hope to have a few more of such webinars going forward, and we look forward to having you on board. Laurent and Vivek, thank you once again for your time. That was very insightful, and we'll definitely have a lot more of these.
Thank you.
Thank you. Good evening.
Bye.